You're listening to Across the Pond, a show about improving the lives of British expats living in America. Brought to you by Plan First Wealth.
Hello, welcome back, everyone. Rich, just jump straight in. Kick us off.
Okay, right. So before we crack on with today's topic, I just wanted to do some housekeeping. So if anyone's like stumbling across these on YouTube or picking up the podcasts, you might not realise that this is actually part of a series. So if you go to our website, we've actually put together a 12-part series of the topics that we think most impactful, most important to British expatriates living in America, and we've organised it into 4 different categories. And if you go on our website, you'll find like a content calendar under the resources that lists out month by month what topic we're addressing, and then as we address that topic, blog, videos, podcasts, those links will go live. So anyone who's just stumbling across this, head to our website, check that out, see what's going to be relevant for you, what you're interested in, and also, with the categories, at the end of each category, we're doing a webinar. Got the first one was in September, the next one December, and so on and so forth. That's an opportunity for you to get on, hear us deliver this in a different setting, and ask us questions, perhaps.
Mm-hmm. It'll be live.
So I just want people to, I want people to be aware of the existence of this 12-part content or topic calendar that we've got, and that we're putting out over the next few months. And the webinars. Also, we have a private Facebook group, Plan First Wealth Hub, right? On
Correct.
Facebook.
Yeah.
Where people are invited to join, ask questions. We'll also be doing, or we plan on starting to do a monthly Q&A live on there soon, right? So if anyone does have questions, join, participate, ask away. We'll do what we can to help. And I think that's everything, right?
It is, yeah.
Okay, good.
This week's topic, then. We've
this month's topic.
This month's topic, sorry. We've touched upon it a couple of times, haven't we? In the last few episodes,
It's hard not to.
It is.
So, to put everyone out of their misery, suspense is building. The topic at hand is PFICs. Passive foreign investment companies. What do we mean by that? Really, it's non-US investments. More specifically, non-US collective investments. In the UK, unit trusts, OICs. Yeah. Essentially, we're talking about any ETFs. Obviously, we're talking about any. So, if you've got a Fidelity fund, an Invesco Perpetual fund, BlackRock fund that's in the UK, any UK fund or any European fund, any non-US, I'm overcomplicating, simply any non-US fund, anything that's in dollars, anything that's in pounds or euros, sometimes in dollars. There are definitely European dollar-based collective investments, but why would anyone have that? I don't know. But we're talking about non-US collective investments, which are incredibly common, incredibly mainstream, utterly benign under most circumstances, take on a different life in the US.
When you hold them as a US person, don't they?
Yeah.
What was once working for you as a UK person, living in the UK, holding these collective investments, let's say an ETF, was working for you there, but now you're in the US. The US don't like them. Put it simply, do they?
Why?
It actually originates from 1986, I think, where the US brought out rules to essentially encourage everyone to onshore any investment overseas. And the way that they got people to do that was to punitively tax people that have investments overseas. And they brought out rules called PFIC rules, and that catches so many people now.
So it's just my interpretation of this is the US takes the position that if you are a US person, which is people living here who aren't US citizens, and also US citizens abroad, which is a real It's really unfair. If you are investing outside the US, it seems to be that their starting position is you're hiding from us. You are trying to avoid your tax obligations. You are hiding money from us. And of course that was happening. Of course it was. But there's also many circumstances when that's not happening. When someone comes to the US temporarily from Europe or wherever, right? It doesn't matter. And they want to hold on to their non-US investments in their domestic currency. Utterly reasonable, in my opinion. But can get very messy. Or when a US citizen moves abroad and settles abroad, they understandably surely want to build up investments in their new current currency of their lifestyle. It's going to cause them some serious problems. So I understand where it comes from. The US is reasonably maybe paranoid that people are trying to hide money offshore. They introduced these rules, PFIC rules, in 1986. You say more recently FATCA in 2010, I think, which absolutely discourages offshoring, but penalises unfairly a lot, in my opinion, a lot of people who are not trying to avoid US taxes, who are not trying to hide money, who just want to hold investments in other currencies for good, legitimate reasons. But, we've got to put that to one side, isn't it?
It is what it is.
Whinge and whine and complain about this for hours, but people aren't here to listen about that. They want to know what's the problem, right? So what's the problem? So you've got PFICs. Loads of investors have PFICs. Like I say, they move here with PFICs. They accumulate them when they're here because they inherit some pounds, or they get paid in pounds or whatever, or euros, and they think, I'll invest this. They buy what they think is what is a mainstream benign collective, mutual fund ETF, and unwittingly now they've got this PFIC problem. So why is it a problem? Well, to your point, the US considers that you're trying to hide money. So they want... actually, let's go back a stage. With US investments, US collectives, tax is due on a much more regular basis. So as dividends are paid out, even if they're reinvested in the fund, they are distributed that year, essentially, and they're taxable in each year. And also, capital gains disposals within the fund can be, even if the investors don't take that money out, it can be taxed in that year. So an investor might hold in the US might hold a fund for 10 years, but they're taxed throughout that 10 years. But with offshore investment, very often the US is not getting any money until it's surrendered, or a dividend is paid out in a significant lump sum in future years, and they consider that lost revenue. So how they go about reclaiming their lost revenue is they apply some pretty punitive taxation rate rules, and those rules are that excess distributions from a PFIC. Now, it's quite technical on what excess distributions are. Just for our intent, and you go onto the blog. We've written about this. We've provided links where you can do a deep dive if you want to get really specific. But just know that most receipts from a PFIC, whether it's a surrender of the fund or a dividend, are going to be excess distributions, and they're going to be subject to the excess distribution regime, which is earnings, i.e. profits and dividends, are mostly subject to the highest income tax rate. Not your marginal income tax rate, the highest income tax rate. Currently 37%, prior years 39.6%, and so on and so forth. So, to put that into context, capital gains tax is usually 15 or 20%. The most dividends are taxed at the same rate, 15 or 20%. Most dividends and profit distributions or surrenders from a PFIC are going to be taxed at 37% federally, and in the slice we'll get into in a minute, slice for prior years, maybe 39.6%, and so on and so forth. It gets worse. I mentioned if we use that 10-year example, they not only are they going to tax you now for most of that at the highest marginal rate, at the highest rate. but they also want to be repaid for the lost years. You know, they could have been collecting it annually, give or take, for the last 10 years. So what they're going to do is they're going to slice up your gain by your holding period. I'm dumbing it down a little bit, but again, without getting too granular, I'm just trying to make it make sense. They're going to slice up your gain by the holding period, and they're going to apply interest for each period. So let's just 100 grand gain. You surrender an investment this year for 100 grand. Yeah, sorry, you make 100 grand gain, and you've had it for 10 years. They're going to slice that gain up by 10, so it's 10 years. So 10 chunks of 10 grand, and they're going to apply the highest income tax rate in each year. So 37, 37, 39.6, 39.6, 39.6. I think it was 35 many years ago, but you know, high.
Mm-hmm.
The most recent year is your current marginal rate, but that's only one slice of 10 grand. The rest of it is the highest rate, and then they're going to apply interest. So the chunk that was considered due 10 years ago or 9 years ago is going to have 9 years worth of interest, and then the next one 8 years worth of interest, and 7 years worth of interest, and so on and so forth. So you're getting absolutely
what is the interest? You know,
you have to go on. You can go on the IRS website and see what it is for each year.
Right,
it changes, but it adds up.
Yeah,
and it can't be abated.
Compound.
Yeah, it can't be abated. Penalties can be abated. I believe taxes and interest are constitutional. They can't be abated. They are enshrined. All right. So even if the IRS wanted to, which they don't, they can't be abated. So just to wrap this up, you've got your 100 grand gain. Ignoring any state issues, it's going to get taxed at, most of it's going to get taxed at 37, 39.6, 35%, whatever, plus interest. You know, you're getting into 50, 60% of the gain.
Wiping away a lot of your gain.
Yeah. And there's no benefit in delaying this, saying, "Oh, you know, I'll worry about," because your interest just keeps accumulating. I had someone once approach us who'd moved here in the 80s with a portfolio of PFICs, like everyone does.
Okay.
This was an accountant, a chartered accountant from the UK, done his own taxes for however many years, and he now had this substantial portfolio, completely unaware of the PFIC regime, completely unaware, as we all are or were, and you 30 years worth of interest, and there's no options other than, you know, the longer he delayed, the more interest would be applied. It's brutal. It's absolutely brutal.
Did he rectify it?
I don't know. McLean, I don't know.
Couldn't afford you. Yeah.
You have to. Because the other aspect of it is there's the reports. Not only are PFICs expensive from a taxation perspective, they are expensive from a reporting perspective. Each PFIC is required to have its own Form 8621 pretty much every year. I think it used to be not required every year, but now I think it's so you've got a portfolio of 10 funds in a portfolio, 10 PFICs each year. Each an accountant's tax advisor is going to charge you a few $100s for each individual 8621. That's going to add up. So
online they say that it takes 40 hours to complete one 8621. Now I haven't seen it, but that's what it says online. Each form. I had a look this morning on Investopedia.
Wow.
Yeah.
Wow.
I know.
That's nuts. I did not know that. I've looked at the form. I mean, it's
Right.
not. I mean, no IRS forms are particularly friendly. Could you make the font smaller? None of them are particularly helpful, I don't think. But wow, I did not know that.
No. So imagine the hours. I mean, I don't know if it does actually take 40 hours. I'm sure probably not, but especially a specialist that knows the form. But just imagine the hourly rate if you've got 10 ETFs.
So PFICs, bad. Avoid. If you have PFICs listening to this, you are not alone.
Where do they usually
can't-
arise? Where do we usually see them?
I would say I see them from people having moved here and just assuming, as they could move anywhere else and just maintain this portfolio. Especially in ISAs. Let's park that and we'll come back to wrappers, but especially ISAs. But people moving here, people inheriting and having pounds and not wanting to convert it at the exchange rate, or thinking they're going back and then investing in a pound portfolio. US citizens abroad. Americans who have moved to the UK, or Brits who have moved back to the UK from America, are citizens, start earning in pounds, saving in pounds, investing in pounds, don't realise that they are creating a mega issue for themselves, because all this applies to US citizens outside of the US as well, who still have to do tax returns. Again, that's a topic. If you go to our content calendar, you will see that's a topic for another day. But that's where I see it most of all.
Yeah, it's probably why a lot of UK advisors, traditional UK advisors, just stay clear of US citizens in the UK. Tick a box, you say you're a US citizen, they just literally computer says no, we can't work
they
with you.
don't.
And it is one of the reasons.
Yeah. Or they don't. Or they just they go into it blindly thinking, so what, American? How hard can it be? And create a whole myriad of issues. Because it's not like being a citizen of France or anywhere else, which it's just not.
Or even the UK. The UK doesn't have long arms like the IRS do. Long punitive arms.
Right. So we touched on it a second ago about wrappers. And what do we mean by wrapper? So when I talk about a wrapper, what we mean is tax wrappers. So a pension is a tax wrapper. An ISA is a tax wrapper. An endowment policy is a tax wrapper. An investment bond, yada, yada, yada. I could go on. I will stop, I promise. But, it's essentially where investments have a structure around it that changes the tax treatment. So ISAs are very popular in the UK because they allow tax-free growth and income to be received from the funds. Pensions are obviously a very popular wrapper in the UK, but treated very differently in the US. So we go back to as per our last podcast, we start looking at tax treaties. So a tax treaty, so for a US, God, I'm getting really tongue-tied here. A British expat in America who's got an ISA and a pension, both contain PFICs. Pension's probably okay, because again, there is some debate about this, but mostly it's regarded as okay because under the treaty, the US looks at the wrapper, sees it's a pension. Most pensions are pensions under the treaty. Therefore, the US kind of stops there, and most tax advisors agree that a UK pension can hold PFICs, doesn't have to do 8621, avoids all the bad stuff, right? But an ISA or an endowment policy or an offshore bond or an onshore bond, different matter. Onshore bond might be insurance, but that's part of that for 1 second. But in ISA, there's nothing in the treaty that respects that. So my understanding of it is the IRS looks right through the wrapper and sees the underlying PFICs. So you've gone from having a super tax efficient, tax advantaged wrapper in the UK to not only losing that tax advantaged status in the US, but now looking straight through to the PFIC, you've not just lost the tax advantage, you're now at a tax disadvantage because you have PFICs and they're going to get absolutely walloped, and you're going to have a nightmare, administratively with forms and all that stuff. So it's a double whammy. I told you it's pretty brutal.
Plus interest.
Yeah. It's horrible. It's horrible. I really, how many times have we had a call with someone? It's just like, disbelief, denial, the stages of grief, and my heart goes out to people because it's just so unfair, I think. But deal with it. It needs to deal with it, get it done. We had this recently where some clients who have worked around Europe just took my advice. We introduced them to a cross-border tax advisor. They just dealt with it. They ripped the Band-Aid off. and they're much happier. It wasn't fun. They didn't like it. They didn't enjoy it. But it's done. It's behind them. It's solved. Everything's in the US now. They're retiring in the US. They're much happier. Just having ripped the Band-Aid off.
They got peace of mind. Now, having been made aware of it, to solve it, who does solve it? Do we solve it?
No, I told everyone they're going to get bored of hearing us say this, but if you have PFIC, well, we're happy to talk to people to start with, but ultimately this is best resolved with a cross-border tax advisor, not a local CPA, not a domestic CPA. Most are not. Many don't know what PFICs are. Most have no experience with 8621.
It's why there's quite a lot of. It's why we see the problem so frequently.
Yeah.
Is because you might be using a CPA, a local CPA in the US, who presumably knows the US forms, but they don't work with foreign-born people who have international assets, and there's just oversight. And you might be thinking unwittingly that you're doing the right thing, working with a CPA that does my taxes every year. And that's good. That's great. Unfortunately, it's not a cross-border CPA who can identify the problem and solve it.
Yeah. So that's our standing advice, isn't it? Really, is speak to a cross-border CPA who understands these issues, who know and who can help you chart a path forward through this.
Individual stocks are okay, aren't they?
Yes. Yeah. So there are. You can have GBP or euros managed in what we call PFIC-free portfolios, which are portfolios for people with these kind of issues or have got this, who are US citizens or US people. And you just have to avoid PFICs. It's direct equities, it's direct corporate bonds, treasuries, gilts. It's just collectives. Again, the what makes a passive foreign investment company is it's something to do with like if 75% of the income is derived from passive sources. I can't. Again, go to our blog, drill down there if you want to get super technical. We should say as well, in my experience, the vast majority of non-US collectives, OICs, unit trusts, ETFs are PFICs. There are elections available to have a PFIC treated differently. I won't go into them now. I think there's two, but they are much more tax advantageously. They're few and far between. I'm absolutely sure there are specific PFICs out there catering to US people that do make these elections, but the vast majority, if you've got Fidelity or Invesco Perpetual or a Fundsmith or any, just pick your big fund house in the UK or Europe, it's not going to be a PFIC. The reason being is, to make these elections, it requires, I think, the cooperation of the fund house, and they have to agree to supply the US with certain data, and just no one's going to do that. No one's going to volunteer. No, you're not going to approach Fidelity and say, "Oh, guys, by the way, would you mind taking the election and then supplying the IRS with all this information?" It's just not going to happen. So, if you if anyone does any research after this and you read about these available elections, yes, in theory they are possible, they're available. The reality of it is they're not. If you've got these funds, your only way out of them is out and deal and tidying them up and dealing with the consequences and moving on. In my experience.
Mm-hmm. Yeah, ripping the Band-Aid off is really the best way of summarising what you need to do, really, once you've identified it.
Yeah. Do you know what? So I said before, pensions, in my experience, or in most of the advisors we talk to, they say the US stocks at the wrapper, the pension wrapper, and therefore it's okay for these pensions, assuming they definitely qualify as a pension under the treaty, to hold PFICs and not be subject to the rules and not have to do 8621. I think there is dissension out there. I haven't actually ever encountered it personally, but the overwhelming position on the tax advisors we've spoke to has consistently been, if it's in a pension, that pension's recognised by a treaty with the US, they're okay to hold PFICs. We're just putting it out there as nearly everything in the cross-border community has dissension somewhere. There seems to be a lot of grey areas.
Mm-hmm. I think there always is between any countries, I guess, because you just rely so heavily on the double taxation treaty, which doesn't make comment on every asset.
The specifics, yeah.
Yeah, so it is grey area, tax, legal opinion, getting behind a legal opinion and tax people that you're confident in.
Yeah. What I've learned this year is that operating within that grey area is the most important thing. Really, is to never take a position that's frivolous or considered frivolous. So people with cross-border affairs.
Is that a term? Like a tax term?
I think so. Yeah. So the people with cross-border affairs are who have got these. So someone's got a random endowment policy from the 80s. Like, how do I treat this? I'm making that up, but you know what I mean. Like, think of all the weird esoteric products from the UK in the 70s and 80s, and then multiply that by every country in the world. So I think what happens is cross-border tax advisors who are it's not just cross-border, right? It's people who are familiar with the country where most of your other assets are. Like a generic expat tax advisor in the US who doesn't understand what a UK onshore investment bond is compared to an offshore bond and how they're different and taxed completely differently, and what might be a look-through wrapper and what might be an insurance wrapper. You need someone with that kind of granular knowledge. And anyway, so back to my point. Every year, people are taking a position. Like, they're looking at the treaty, looking at what product they've got, and saying, applying the terms of the treaty, I believe this is treated this way. And as long as it's a good faith, logical exercise, I think that's generally considered okay. It's when you take a frivolous position. It's when the rules say X and you're like bending it to try and do Y. That's frivolous. And I think when you take a frivolous position, you actually have to a tax advisor is legally obligated to submit another form that notifies the IRS you are taking a position in opposition to what they believe to be the case, and that you just don't ever want to be in that position. I don't think. No.
Not only are you taking a different position than what is probably black and white, you then have to tell them. That seems like
just red rag to a bull, right?
Exactly.
So look, this is a financial advisor here now sprouting technical tax stuff. So usual caveats apply. I'm not a tax advisor yet. I'm not a tax advisor. I've just learned a lot about this stuff, and I'm trying to relay it in a way that hopefully makes sense to people. But this is a little bit outside of my wheelhouse, and if I'm wrong, I do apologise. If you're a US citizen outside the US listening to this applies to you, or green card holder, but I'm mainly talking about US citizens. You're in an even trickier spot because you have to avoid PFICs as a US citizen, which means investing in the US is likely more attractive for you in US dollars, even though that might not be ideal for you currency-wise. But oftentimes the country where you're based will also have restrictions on foreign investments. I think that's actually the topic of our next blog and podcast about reporting funds and non-reporting funds in the US. So just set that up nicely. But yeah, if you're listening to this from outside the US, yeah, you might be even in an even tighter spot.
You've got less options, haven't you?
The joys of US citizenship, yeah. Again, all this stuff, everything can be navigated with knowledge and the right team of people. The mistakes happen when you're not aware of this stuff, which is totally normal, but you don't have the right people around you who are aware of it and who can help you navigate it. That's when I see the biggest mistakes happening.
Great. So, if you think you might have a PFIC, or PFICs, then you can reach out to us, and we're happy to have a call. We'll probably send you to a CPA, but we can help you put a plan in place.
We're happy to chat.
Yeah, we are.
And I would just say, warning: don't just jettison them. Everyone should know by now. 2010 FATCA, which is an act. I think it's an act of Parliament then, which is an act which, long story short, means that for most foreign financial institutions, banks, investment houses are reporting back to the IRS details of their American clients, customers, investors, including you. So just jettisoning it and hoping it goes away, the IRS might even already know about it. Or they might be sat somewhere. They might have that information, and haven't got round to it yet. So again, don't just think you can... Don't just jettison this and hope it goes away, because it might rear its head up in a much worse way in the future.
What a somber way to
I feel like the harbinger of doom.
Yeah,
sorry.
Exactly.
Sorry. Speak to a tax advisor. It can normally be sorted out. Yes. Yeah. Okay. Right. So, everyone go to our... please go to our website. Check out the calendar. See what we've already done. See what's coming. Sign up to webinars. Join the Facebook group. Ask questions. Attend the Q&A if you like. And we shall see everyone next time.
Thanks for listening to this episode of Across the Pond. This podcast is brought to you by Plan First Wealth. For more information about Plan First Wealth and Across the Pond, visit us at planfirstwealth.com. If you like this episode, consider sharing it with fellow Brits across the US. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you listen to your podcasts. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.